How to keep costs low to increase your return. Hey, I'm Angela Lin, international best-selling author. When you're buying your investments, it's important to keep costs as low as possible. When I say costs, I'm talking about buying, selling, or management costs. Why? Because this will affect how much and how quickly you'll be able to grow your wealth. When you invest in funds like mutual funds or index funds, you'll need to pay fees for as long as you own it. These fees are paid to the companies that provides these funds for managing it. The big difference is that mutual funds are actively managed, meaning there's a mutual fund manager whose full-time job is to decide which company's stocks to buy and sell in their mutual fund. The mutual fund manager is like a convenience store manager in that he needs to be there most of the time. He needs to decide which products are selling the best, buy more of them, and stock them so that more customers will buy them. Then he needs to get rid of those products that aren't selling well. Now, the goal of an index fund is to move as closely to what's called an index as possible. It can be a stock index, which is like a basket of stocks. The S&P 500 is an example of a stock index. So these are passively managed because they don't need to decide which specific companies to buy and sell. It doesn't require a fund manager to constantly manage it. The index fund manager is like a vending machine manager. He doesn't need to always be at the vending machines to make money. He just needs to check on it every week to restock and make sure that everything is working. He knows what he needs to buy to stock the vending machine since it's already selling well. It doesn't change much since it already has a good mix of what's already selling. So can you answer a question for me? Do you think you'll need to pay more to the convenience store manager who's constantly ordering, restocking, getting rid of things that aren't selling, selling them to customers, etc.? Or will you pay more money to the vending store manager who comes once a week to just restock the things that already sells well? If you guessed the convenience store manager, you're right! For mutual fund managers who are like the convenience store managers, you'll need to pay for their full-time salary since they're working a lot of hours and have to pay a lot of costs because they're buying and selling, and these all require a lot of fees. High fees known as transaction costs. Meh, so what's the big deal? Well, mutual fund managers will often tell you that you just need to pay our small fee of just 0.9% of what you invest with us. They'll call this the expense ratio. This means that for every $100 that you invest with us, we'll just take 90 cents from you for our fees. They might even say, oh, don't worry, it's no load, meaning it's just 0% expense ratio. Well, guess what? Here's what they forgot to mention. There's hidden fees. There's hidden fees of transaction costs and cash drag that you're forced to pay as well. In a Forbes article called The Real Cost of Owning a Mutual Fund, Ty Bernanke found out that the average cost of owning a mutual fund is 3.17%. That means that for every $100, you are paying us actually $3.17, and not just 90 cents. Oops, did I say that out loud? It's like if you went to a restaurant and you originally just tipped them 10%, but the service cost ended up being 30% without them telling you. Would you be mad? I would! Why does it matter? Well, let's assume you invested $100,000 at 8% average annual return for the next 30 years. This means that if you invested with 3% annual fees compared to just 1%, that they told you, well, you're going to have $329,000 less. Okay, $329,000, just go. Imagine if you lost $329,000, all because of hidden fees. What could you have done with the money instead? Well, with $329,000, there's a lot that you can be doing and buying. Not to mention that you can retire earlier so that you can live life on your terms. Well, guess what? Instead of you enjoying all that, it's your mutual fund manager. using up all your money to enjoy life. And you can't sue your mutual fund manager since it was you who agreed to these terms when you invested in that mutual fund. Now let's see how index funds compare to mutual funds in terms of fees. What you can do is look for a low-cost index fund, meaning they charge a low fee. You can find low-cost index funds that have lower fees than mutual funds, but actually outperform them. Oh no, don't listen to her. Many low-cost index funds are only 0.2% in terms of fees. And this is all the fees. There's no more hidden fees. Compare that to the 3% for mutual funds that we mentioned earlier. So now you might be wondering, well, if I'm paying higher fees to these mutual funds, wouldn't that mean I should get higher returns? According to Delbar, one of the leading industry research firms, over 20 years from 1993 until 2013, the S&P 500 returned almost 4 times as much as just the average mutual fund investor. So action step, you can buy low-cost ETFs or index funds instead of mutual funds, unless those mutual funds have total fees of less than 1%. Post as to what is your biggest question about investing so that I can create even better videos to help you and serve you. If you like this video, click below to subscribe and make sure to get your free checklist of how to invest your $1,000 and grow it to $1 million. You can get the link below this video so that you can take action and start getting results. Until the next video, thank you so much for watching, and here's to you living life on your terms.